Tapping into your home's equity can feel like unlocking free money, but one wrong move could put your entire home at risk. So, how do you actually use a home equity loan to get ahead, not fall behind? In this video, we'll break down the smartest, safest ways to use your equity, from paying off high-interest debt to funding upgrades that increase your home's value so you can build wealth without putting your financial stability on the line. Use a home equity loan to consolidate high-interest debt into a lower fixed-rate payment. Credit card interest rates often sit between 18% and 29%, which makes it incredibly difficult to make progress on balances if you're only paying minimums. A home equity loan, on the other hand, may offer rates closer to 6 to 10% depending on your credit and market conditions. For example, if you have $20,000 in credit card debt at 22% interest and you switch that to a home equity loan at 8% over 5 years, you could save thousands in interest and have a clear payoff timeline. The key is discipline. Once the credit cards are paid off, you must avoid running those balances back up, or you've effectively doubled your debt. Also, remember that you're converting unsecured debt into secured debt backed by your home, so missing payments can lead to foreclosure. From a tax perspective, interest on home equity loans is only deductible if the funds are used to buy, build, or substantially improve the home. So debt consolidation interest typically is not tax deductible. Before moving forward, calculate total interest savings, closing costs, and confirm the fixed monthly payment fits comfortably within your budget. Invest home equity loan funds into value-adding home improvements that increase property value. Not all renovations are equal, so the goal is to focus on projects that either improve livability or provide a strong return on investment. For example, kitchen remodels, bathroom upgrades, energy-efficient windows, or adding usable square footage often increase resale value. If you borrow $30,000 at an 8% rate to remodel your kitchen and it increases your home's value by $40,000, you've effectively grown your net worth while enjoying the upgraded space. Additionally, these improvements may allow you to sell faster or at a premium later. Unlike other uses, interest on home equity loans used for qualifying home improvements may be tax deductible, which can reduce your effective borrowing cost. However, you still need to factor in contractor costs, timelines, and the possibility of going over budget. Always get multiple quotes, verify licensing, and avoid over-improving beyond what your neighborhood supports, because that can limit your return. Use a home equity loan to fund education or career advancement with a clear return on investment. Education can increase your earning potential, but only if it's aligned with a specific, realistic outcome. For instance, borrowing $25,000 at a fixed 7% rate to complete a certification or degree that boosts your income by $10,000 per year can pay for itself relatively quickly. Compare this to private student loans that may have higher rates and less flexible terms. However, this strategy requires careful planning. You need to evaluate the expected salary increase, job market demand, and how long it will take to break even on your investment. Also, student loan interest may offer tax advantages that home equity loan interest does not, so you should compare after-tax costs. Since your home is used as collateral, the risk is higher if your income does not increase as expected. Build a repayment plan based on conservative income projections, not optimistic ones, to avoid financial strain. Maintain a conservative loan-to-value ratio and borrow only what you truly need. Lenders typically allow you to borrow up to 80 to 85% of your home's value minus your existing mortgage, but that doesn't mean you should go that high. For example, if your home is worth $400,000 and you owe $250,000, you might be approved to borrow up to around $70,000. But taking the full amount increases your risk if property values decline or your financial situation changes. A safer approach is to borrow only what is necessary for your specific goal, leaving a cushion of equity. This protects you from becoming underwater, where you owe more than your home is worth, which can limit refinancing or selling options. It also keeps your monthly payment lower, improving cash flow. Always stress test your budget by asking whether you could still make payments if your income dropped by 20% or if unexpected expenses arose. This conservative approach reduces the likelihood that your home is put at risk. Choose a fixed-rate home equity loan with predictable payments and align the term with your financial goals. One of the main advantages of a home equity loan over a line of credit is the stability of fixed interest rates and consistent monthly payments. For example, borrowing $40,000 at a fixed 8% rate over 10 years gives you a clear monthly payment of around $485, making it easier to budget compared to a variable rate HELOC that could increase over time. Aligning the loan term is equally important. A shorter term means higher monthly payments but less total interest paid, while a longer term reduces monthly strain but increases total cost. You should match the loan length to the lifespan of what you're financing. For instance, a 10-year loan makes more sense for a renovation than a 20-year loan. Be mindful of closing costs, which can range from 2 to 5% of the loan amount, and check for prepayment penalties so you can pay off the loan early if your financial situation improves. This structured approach ensures the loan supports your long-term financial stability instead of creating uncertainty.